Have you ever placed a trade at support only to watch price break through and hit your stop losses? Or maybe you entered a breakout trade only for the market to reverse immediately against you. If this sounds familiar, you're not alone. The market is designed to trap retail traders, and in this session, I'll explain exactly how it happens. My name is Sahil, and today we are going to compare traditional trading methods like support resistance, indicator, and chart patterns to smart money concept, the way institution and banks actually trades. Let's start with how most retail traders think. The moment trader looks at the chart, the first thing they do is they mark the support and the resistance. They assume that price will respect these zones, bouncing off the support or rejecting from the resistance. Now let's talk about breakout traders. These traders wait for the price to break above the resistance or below the support. Next, we have traders who rely on chart patterns like triangle or trend line. They believe price will follow these formations expecting a breakout in either directions. However, these patterns are often manipulated. Price breakout in one direction traps the traders and then moves in the other way. Some traders turn into indicators like moving averages, RSI, MACD, or super trend. But indicators lag behind price, meaning by the time they signal a trade, smart money has already positioned themselves. Instead of using these patterns and indicators, smart money focuses on liquidity zones, stop hunts, order block, and market structures. Bank and institutions don't rely on indicators or retail patterns. They engineer price movement to create liquidity, then use that liquidity to enter trade at optimal point. Now let's compare how retail traders and a smart money trader would handle the same chart. A retail trader sees a trendline support and enters into a trade, placing their stop loss on the previous swing low. They think that price has taken the support on this trend line and now it will move in the upward direction. Also, few traders see this as a symmetrical triangle breakout and they enter into a long trade at this point. However, markets see these lows as a potential liquidity zone and start melting down, hitting all the stop losses below these lows. Now the other section of retail trader who see these zone as a support line and they think that the support has been broken and they sit for the short trade on these areas. But as you can see, market has taken out their stop losses too. Here you will see how the market has taken out the stop losses of these traders who were sitting in the long trade, seeing this as a support, potential support or a breakout. Also you can see the market has taken out the stop losses of these traders who were seeing this as a potential breakdown trade on a short side, ultimately resulting into their stop losses. Here the smart money concepts comes into the picture. We have the same chart as you can see, but how the ICT trader see it differently. It's just a matter of perspective. They identify the key highs and key lows where the stop losses are pending of the retail traders, and they wait for the market to take out these stop losses pending either on the sell side or on the buy side. Once they see price has taken out the stop losses of the sell side, they are now confident that price will definitely move on the upside to take these liquidities on the upside move. So once they see the price has already taken out the stop losses and price is now ready to reverse, they wait for a reversal pattern, and once they find the entry, they sit for a long trade after price hitting all the stop losses of the retail traders. Now you must be thinking that it's very easy to show something on a line diagram, but what if I show you the same thing happening on the live chart? So let's move to the Nifty 50. So here's a chart of Nifty 50. What we have seen till now, let's try to mark them from the retail's perspective. Here I'll do the same annotation from the retail's perspective. Here we have a trend line going like this. Now also we have some support. Now from the retail perspective, we have to wait and see price to break on the either side. Here you can see the price has given a breakout from the support level. Now what retail trader is waiting, he wants some kind of a retest from these levels so that he can short. So let's see what happens next. Price has come to retest. Now we need some kind of a rejection over here. Now we see a rejection, so retail traders can enter in a short on these levels seeing a retest, and the stop losses will be on this previous swing high and the target will be minimum 1:3. So now you can see how these retail traders who have traded using the breakout strategies of the support level now has been thrown out by the market by hitting the stop losses. Now we have the another chunk of traders who see this trend line breakout. So now they will wait for the retest and they'll enter in a long trade on these zones. So let's see, will the market give them also an entry? So here we have a retest of this trend line you can see and a rejection candle on the trend line. So what the retail traders is now doing, they'll sit in a long trade keeping their stop losses below the swing low, and the target will be minimum 1:3 again. What do you see now? The price has taken out the stop losses of these traders also. So now how to trade? If you're trading on a breakout, your stop losses are getting hit. If you're trading on a trend line resistance breakout, your stop losses are getting hit. Now the question arises, how the smart traders are making money in this market. So let me start again with the same chart showing you how a smart money trader thinks. We have the same chart and will now mark the liquidities according to the smart money traders. Now what does a smart money trader sees? We know that we have the swing highs over here on which we have all the buy stops pending, which means stop losses, and we have these lows on which the sell stops are pending, again the stop losses. Now as a smart money trader, I want to see the price to raid on one side of the liquidity so that I can plan a reversal from those levels. So now let's mark these liquidity and see how the market is reacting. As you can see, the price has taken out these lows, which means the sell stops has been raided. Now the interesting part is we have all the buy side liquidities pending on these highs. So the price will naturally tends to move or attract in these directions because already the sell stops has been taken. So there is no need for the price to move further down. So I'll place a long trade on these zone by placing my stop loss on these lows. So let's do that. So you can see how the price has given us the entry and the target has been done within a few minutes. This shift in perspective allows smart money traders to avoid traps and position themselves with institutional move rather than against them. So now that you see the difference between the retail trading and smart money concept, you have two choices. Keep trading retail patterns and getting stop out, or start trading like smart money, understanding liquidity and institutional price move. In my course, I'll teach you how to stop trading like the 99% and start thinking like a professional. You will learn order flow, liquidity manipulation, market structure, and risk management with live trading drills to help you apply these strategies effectively. If you are ready to take your trading to the next level, let's move ahead and start the course.